Why is the shadow banking system vulnerable to liquidity crises? Imagine a financial world where many players act like banks but aren't actually part of the official banking system. That's what the shadow banking system is all about. It includes institutions like money market funds, investment companies, and special financial conduits. They perform bank-like functions, such as lending money and creating credit, but they do so outside the rules that govern regular banks. The main reason this system faces risks during liquidity crises is because it relies heavily on short-term funding to support longer-term, less liquid assets. Think of it like borrowing money for a short period to buy something that takes a long time to sell or turn into cash. This process is called maturity transformation. For example, shadow banks often borrow through instruments like commercial paper or repurchase agreements, which are short-term loans that can be withdrawn quickly if investors lose confidence. Meanwhile, the assets they hold, such as mortgage-backed securities or loans, are not easy to sell fast without losing money. If investors suddenly decide to pull out their funds, these shadow banks can find themselves unable to quickly convert their assets into cash. This creates a liquidity crunch, where they do not have enough liquid assets to meet their obligations. Unlike traditional banks, shadow banks do not have access to central bank support or deposit insurance. This means they cannot easily turn to the central bank for emergency funding during a crisis. Without insured deposits, their creditors are more likely to withdraw funds at the first sign of trouble. This makes their funding structure fragile and prone to runs, similar to bank runs but happening outside the formal banking system. Historically, the shadow banking system grew rapidly from the 1970s onward. It expanded as traditional banks faced more regulations, pushing some activities into less regulated areas. Money market funds and securitization became popular ways to finance loans and investments. This growth was partly driven by the desire to avoid regulation, which allowed shadow banks to operate with higher leverage and less oversight. During the financial crisis of 2007 and 2008, the weaknesses of the shadow banking system became clear. When short-term funding dried up suddenly, it caused a credit crunch that worsened the crisis. At that time, the size of the shadow banking sector was comparable to or larger than traditional banks, making its instability a major concern for the entire financial system. In summary, the vulnerability of the shadow banking system to liquidity crises comes from its dependence on short-term funding for long-term assets, lack of access to central bank support, absence of deposit insurance, and high leverage. Its interconnectedness with the broader financial markets makes it a key area to watch when studying financial history and understanding past crises.